morning to you all. Just give us a couple of minutes. I think people are still coming in, so we'll go live and start talking to you very shortly. I can see the numbers still rising quite quickly. So if you can bear with us, we'll just give everybody a chance to log in. Great. I think we're about there. Good morning and a very warm welcome to BDO's webinar on the spring budget. I see that the weather hasn't been very kind to us, so it doesn't feel very much like a spring budget at all. But it absolutely is a spring budget, and at least we can hunker down a little bit and talk about tax. That's always keeps us all warm. So a couple of bits of housekeeping. Firstly, I would say that we are recording this session, so please bear that in mind. So there will be a recording of the session, and that will be shared with everybody and people who weren't able to make the session afterwards. I would also say that if you've got any questions, please drop them in the Q&A box at the bottom of the screen. If you go to the bottom of the screen, there should be a question and answer box. If you've got any questions, please do drop them in there. We'll try and answer them at the end of the session. Any that we don't get to, obviously we will try and move that forward. So possibly if we move on a slide, please. Great. So we've got a fantastic agenda for you this morning. Got some really good speakers who are going to talk us through all the different tax elements of the budget. I'm going to drop back in for the indirect taxes session, which is going to be slightly less interesting than the others, but it's going to be there, and we'll work that way through. So if we move on to the next slide. Once again, welcome. A fascinating spring budget, and the first from Chancellor Jeremy Hunt. Interestingly, this is at least the fourth different Chancellor of the Exchequer in consecutive budgets. It might even be more than that now. Absolutely terrifying concept. We can also see the shadow of the Kwasi Kwarteng Liz Truss budget, really sort of overpowering this one as well, as it did the autumn statement. There's an element of caution throughout this, although there's a lot more in this budget and a lot more policy changes in a lot of different areas. So if we move to the first slide, let's have a look at what the Chancellor was faced with when he put this together, this budget. Some really good news from the OBR on rising tax revenues. That gives him a little bit more room to manoeuvre. Energy costs falling, which is obviously a very welcome sight, and an amazingly, it's amazing to see the fall in inflation so quickly. So that's all very positive. Against that, the economy is still incredibly challenging. Growth is flat or indeed slightly negative. Public sector pay is still causing a number of issues, and indeed we have more strikes today, and I believe more strikes on the horizon as well. So public sector pay is still very much an element that the government is struggling to get control of. The elephant in the room, of course, is debt, and the debt burden going forward. The debt is still rising, albeit slightly smaller, slightly slower than it was previously, and that debt interest burden is going to be a factor for the next couple of years at least. The fiscal rules say that that they will start paying that back by the 5th term of Parliament, and just about the OBR numbers show that they're just about going to make that, but they're not going to be paying an awful lot back, and it's going to be 27 before any significant sums go. So next slide, please. So, did we get into recession? Well, one of the big news is from yesterday, no, we didn't. We managed to avoid the technical We avoid the technical definition of recession, so we are not in recession, which is very, very positive. However, that is a technical definition of recession, and actually the economy is still slightly smaller now than it was before. And just about all of the growth forecasts that I've seen is showing negative growth. So not a rosy picture, but nowhere near as bad as it possibly could have been. So once again, throughout this, the economic viewpoints, it's peppered with positive news, but balanced with a really challenging background. So let's move on to the next slide and talk about inflation. One of the major surprises yesterday, for me anyway, was the OBR predicting that inflation would reach below 3% by the end of the year, 2.8%. I've got to say, personally, I find that incredible, and I'm really going to be surprised to see if we will ever get to that point this year. I'll be very, very surprised indeed. Most commentators, I think, realise that there are two elements to the inflationary pressures. There's the inflationary pressures driven by the energy crisis, which can pretty soon be brought under control, but there is core inflation as well, driven by wage inflation and supply side inflation. So I think we are going to see that being a little bit tougher, and I would be surprised if we are below 3% by the end of the year, but who knows. The OBR say we are, and certainly I would warmly welcome that if that is the case. So if we move to the next slide. Future growth has been upgraded from the November forecast, which is once again very welcome, but once again a bit of a mixed picture, because although it's slightly faster in the medium term, it kind of flattens off and goes back to pretty much the same kind of growth trajectory as it was historically, seen in November and before. So as I think most commentators have predicted, there will be some growth going forward, but it will be very, very low growth and following pretty much the same projection as before COVID. So if we move to the next slide, what did the Chancellor do about it? Well, the Chancellor announced a budget for growth, a budget around the letter E. So this is a budget brought to you by the letter E. Enterprise, employment, etc., etc. So the first thing he did is look at capital allowances on investments, allowing full expensing. Now, Liam will talk to us in more detail about that, I'm sure. But the slightly disappointing thing there is that he's time limited it to 3 years, although noting that he would like to keep it after 3 years. It is time limited. Most business will see that as a bit of a negative, because obviously certainty is better in many ways, so we don't really know what's going on. I think what's driving that is further commitments to bring the corporation tax rate down. If you have a low corporation tax and full expensing, obviously it will have a double impact on things. So that's probably what's in his mind when he's limited it. But good news, although once again balanced with the bad news of it being time limited. There's a whole raft of measures supporting people back to work on the employment side, from changes to pension arrangements right the way through to changes to the benefit system. Once again, all very, very warmly welcomed. We'll see how impactful they are. I think from a macro point of view, it's interesting to see childcare increasing so much, and actually seeing childcare moving from being a personal objective of individuals to being an objective for government to be involved in, a trend which started some years ago and is actually accelerating now. There's some targeted SME support on the R&D side, so welcome to those in that benefits. And once again, Liam will talk to us a little bit more about that in just a moment. And the introduction of investment zones, 12 investment zones around the country. Once again, economically, always a bit of a controversial one, these, because there's never really entirely certain whether they create investment or whether they just move investment from one place to another. And part of the government's levelling up agenda, what they've managed to get it under E by using the term everywhere. maybe that's what they're doing there with the investment zones, just to move that investment around the country. So, in summary, a relatively cautious budget, but with a whole range of very, very small policy levers being pulled. I think we can see the shadow of a Chancellor trying to make sure that he's got some money to spend in coming budgets, with a view to having an election in the coming years. But a budget for growth, and we'll see how impactful that is. So, without any ado, let's dive into the detail, and I'll hand over to Liam. Liam, over to you.
Thank you, Glyn. For those that don't know me, my name is Liam O'Doherty. I'm a partner in our Manchester office. If we could go down to the next slide. We'll start with the corporation tax rate, and absolutely no surprises here. After a bit of hokey cokey on rates over the last couple of years, we're finally going to get the 25% sort of tax rate from the 1st of April. And that's for large companies. For small companies, there'll be a 19% tax rate, and there'll be a tapered rate in between those two sort of levels. No surprises there at all. But the most interesting thing in the budget, quite often in a budget, we get a roadmap of what sort of the tax rate is going to look like into the future. In this budget, we only got visibility of what the tax rate is going to look like for the next 2 years, which I suppose begs a question. Do we have a consensus of a kind of a highish tax rate of 25%, which is where the Labour would be? And are the kind of the levers for generating growth, are they the use of reliefs? So question mark, are the Tories now where Labour are with that consensus? Or are the Tories leaving room to sort of revisit sort of what the headline tax rate is in the future, potentially when sort of finances are in a better state, potentially just before a general election? We'll have to wait and see. But for the moment, we have a 25% tax rate, and the Chancellor has billed this as a budget for growth. And the only real levers with that tax rate that he has for growth are reliefs. And so we'll sort of talk now about a couple of the reliefs that have been introduced and sort of the potential impact they might have. If we go to the next slide. Firstly, capital allowances. It was well flagged before the budget that the super deduction and special rate allowances would end on 31st of March 2023. They, of course, were responses to COVID to try to stimulate some investment in the economy. The question would be what was going to follow, and the Chancellor didn't disappoint. With regard to the main pool, and if you remember, the main pool is loose chattels, plant and machinery, computers and the like, and some aspects of building expenditure. The super deduction was replaced with a fully expensing regime. What that broadly means is it's a bit similar to sort of 100% first year allowances. Whatever you spend, you get relief for in the year of the expenditure. For the special rate pool, which are kind of more integral features in buildings and long life assets and the like, there's a continuation of the 50% first year allowance regime. And both those regimes will last for 3 years. The Chancellor has hinted that he would like to make both of them more permanent, and it suggested that would be dependent upon affordability. I suppose the benefit of having a fixed period is where you kind of have a potential guillotine at the end of a relief that does typically tend to accelerate investment into those time periods. So maybe that's what he's thinking about when he's sort of capping that at a 3-year period. But we'll have to wait to see sort of what happens at the end of that period. Vehicle charging points, that was announced last year, 100% first year allowances, that's been extended. And investment zones we'll talk a little bit more about later, but worth noting they get sort of 100% enhanced capital allowances. And interestingly also 10% per annum enhanced structural building allowances. And if you remember, the standard rate of allowance for structural building allowances is only 3%. So that's quite generous. So all in all, on capital allowances is probably the area where the Chancellor has invested most in terms of sort of giving up tax take. He recognised that sort of capital allowances and expenditure was perhaps an area where the UK economy had underinvested in the past and perhaps was under competitive with other economies, and these measures were looking to address that. So if we move on to the next slide. So apologies, first of all, that this slide is a bit busy. And the reason for that is there has been an awful lot going on in the world of R&D over the last couple of years, and there continues to be with reform. If I just try to give a quick flavour of what's been happening, I mean, those of you that have been following this will know that the House of Lords sort of looked at R&D, and there was a suggestion that there was a lot of fraudulent or claims that were riddled with errors, and particularly in the SME space, a number has been arrived at of 469 million, not a very precise number, I'm not quite sure how they got there, of kind of excessive claims. HMRC are writing out to loads of businesses with nudge letters suggesting that the claims are wrong and people should review them. They've also invested in 125 new inspectors to run claims in this area. Alongside that, there's a suggestion that there are a number of rogue advisors out there that are putting in inflated claims. And there is a sort of an initiative to sort of tackle and punish those advisors. That's quite a negative backdrop, but the positive side, those that have listened to the Chancellor yesterday will be aware that R&D is a central plank or a central lever to sort of generate growth in the type of businesses that he's looking to boost the UK economy. So there are also a number of changes about sort of making the reliefs more modern and more relevant to sort of current sort of business activities. I'm actually focusing the reliefs on activities that take place inside the UK. Linked to that, there's a sort of a suggestion that the kind of the RDEC regime for large companies and the separate regime for SMEs is too complex. Each were having different rules, and there is a sort of a potential movement towards merging those two regimes, which we'll come back to in a minute. But if we could go to the next slide. So with all that swirling around, what does that actually mean over the next sort of 12 months or so? What changes are we likely to see? Well, it had already been announced that for accounting periods from 1st of April 2023, there would be sort of additional expenditure that would now qualify for R&D. This is part of the modernisation of the regime. So cloud computing, pure maths, data sets, very welcome sort of amendments to bring all those within the regime. Something perhaps a little bit less welcome and to watch out for businesses that aren't currently making claims or haven't made them in the last 3 years. If they now want to make a claim, they need to notify HMRC ahead of making that claim, and they need to do that within 6 months of the end of an accounting period if they want to make a claim for that period. So it's worth bearing in mind if you think that if you aren't making a claim and you think you might want to, putting protective notices in place. Otherwise, you will be precluded from making a claim. One change that we thought we were also going to get from 1st of April 2023 was a restriction or an exclusion of outsourced third-party overseas workers from claims. There's actually been a change in the budget to sort of kick that amendment down the road year, so to delay it 1 year. So effectively, that sort of change won't come into play until accounting periods beginning after 1st of April 2024. Also sort of announced recently a number of administrative changes in and around R&D, and it's worth noting that these will apply to all claims that are made after the 1st of August 2023, which isn't very far away at all. All claims will need to be made digitally. There will be far more detail will need to be submitted with the claim, and that in some instances might mean that there's more work that actually needs to go into preparing claims. Each claim will need to be endorsed by a senior officer in the company, and that's about sort of making sure that the company takes full responsibility for the claims that they're putting in, not deferring to advisors who are perhaps pulling it together on their behalf. Separately, on the advisor front, if an advisor is involved in compiling the claim, they will need to be named on that, and that I think is about sort of agent profiling, but it might also be an attempt to sort of identify claims that have been pulled together without advisors. Certainly one way or another, that's a way of sort of profiling to sort of work out which returns should be inquired into, or which returns that the revenue are going to get most bang from the buck by inquiring into. If we could go to the next slide. In terms of R&D rates, in terms of the mainstream rates, nothing really has changed. There were some changes announced last year that will kick in from the 1st of April 2023. Broadly speaking, the trend is that there is an increase in the benefit of rates for RDEC, large companies, but a reduction in the benefit of claims for SMEs. And that reduction is particularly prevalent for loss-making SMEs. And if you look at the middle row there, loss-making SMEs for £100 of expenditure, they would have been able to get a subsidy back of £33. After 1st of April 2023, that would drop down to £18, £19. And there was a particular concern that would hit pretty hard the very sort of types of business the Chancellor was looking to promote. Those high-tech, high-growth businesses that were potentially loss-making, but potentially could deliver substantial sort of benefits to the UK economy in the future. And R&D is a sizable bit of the cash flow for a lot of those businesses. And there was a concern that this change might sort of damage some of those businesses in that space. And largely as a result of that, if you look at the right-hand column there, there's a new relief which has been introduced in the budget. And this relief is just going to be available for SMEs, and it's just going to be available for SMEs of which more than 40% of their spend is focused on R&D. So it really is those sort of businesses that revolve around R&D in the tech sector. And the good news for those businesses is their subsidy will go up to 27%. Obviously down on the 33% where they are today, but substantially higher than the 18.6 is where they could have been. The other point just worth flagging is in the last week, a consultation's closed as to merging both the SME and RDEC regime, and as from 1st of April 2024. And it's probably important for businesses that are forecasting cash flows and looking forward ahead that there could be further shifts in the level of benefit coming through quite soon. We certainly have fed into that consultation and suggested that sort of merger should be delayed and deferred so businesses have more time to plan for those changes. But we'll wait to see what happens in that space. Just before we go off R&D, I think we've got a very quick questionnaire that we'd just like to ask you to fill in. I don't know if we can get that up on screen. Brilliant. So we've got 2 questions here. I'd be very grateful if you could fill in just to get a sense of what the feeling is out there regarding R&D. The first question is, how confident are you that your R&D claims and documentation are in line with expectations for company size and industry sector? The second question is, how confident are you that your most recent R&D claim will not be inquired into by HMRC? Just give you a few minutes to fill those in. And I think we should be able to get some fairly instant feedback on what the answers are. I know, are we able to get that up on screen? Just give that a minute to see if we can get the answers up. Yeah, there we go. So with regard to the first question, I think most of the answers ranging between very confident, somewhat confident. And on the second question, yeah. So the general theme through there is most people are fairly confident with their claims, and that doesn't surprise me. I think if you've got a reputable sort of advisor helping you with your claim, I suspect a lot of the things that we're talking about here will be navigated through sort of fairly reliably. I think that probably the people that probably need to worry a little bit more are maybe the businesses that have maybe been using a pro forma that was developed a number of years ago and hasn't changed, and have just been refreshing that and following the same thing. I think it's important to update those sorts of scenarios. And the other area, obviously, is the concern is identifying, asking the questions of your advisor to try to identify whether you've kind of got those sort of rogue advisors out there, and ensuring that you haven't got those overinflated claims. But if we could close that down and then move on to the next slide. The other area where I suppose the lever that the Chancellor was pulling to sort of try to generate growth is in and around levelling up, and the knowledge intensive clusters that were first flagged in the mini budget, the Liz Truss mini budget. Now this initiative has been watered down a bit. What's been identified now as 12 areas where we will have these knowledge clusters built around universities, focusing on research sort of in the most budding industries. Effectively, into each one of those clusters there will be 80 million provided over 5 years, and there will be incentives broadly mirroring those in the free ports. Alongside that will be supplemented by levelling up partnerships, which will be spending 400 million on place-based regeneration. So all those changes, I think everybody would agree, are very, very welcome in terms of what they will achieve and what growth that they can stimulate. I suppose the question would be as to whether sums that have been talked about are enough to really shift the dial or not, or how substantial sort of that investment is. If we could sort of move on to the next slide. A few industry-specific announcements. I'm not going to talk in detail on these, but just to sort of flag them for those in those sectors. The creative industries, the arts and shipping industries. There's been also some very specific changes. But if we just move on to the next slide. This slide really covers some of the detail that you might have missed, and again, won't say too much in detail. There's confirmation following a consultation that for large multinational businesses will need to maintain a master file and a local file in line with OECD principles in a prescribed format. There are a number of amendments that are kind of badged under the heading of reducing admin or enabling legislation to work as intended. These are all quite techy legislative areas that the legislation wasn't really quite working, wasn't achieving what it was looking to do. Corporate interest restriction is the one that would probably impact most people. The other areas are all probably investment structures, where I think if you're involved in those structures, you will sort of be interested in those, but probably not of general applicability. The other interesting point is with regard to sovereign immunity. You might be aware that there was a consultation as to whether that should be abolished. Buried in the budget, I think it's just one paragraph. There's confirmation there that's decided there'll be no change to the current exemption. If we can move on to the next slide. Finally, a quick word on business rates. No new news here, really. The headline, of course, is as of April 2023, we'll be sort of using new rateable values. There were some reliefs announced last year to mitigate the impact of transitioning over to those new rateable values. And there are also some reliefs announced last year that are still ongoing to help the retail, hospitality and leisure sectors who continue to struggle post-pandemic, particularly in the current sort of economic environment. But no new changes announced in that space. There was a consultation announced, and I think that consultation will look into issues such as how often rateable values should be refreshed. So maybe sort of more change to come in the future, but no new news in the budget sort of yesterday. And that's a quick summary of business taxes in the budget. Without further ado, I'll hand over to Caroline.
Thank you, Liam. It's very interesting as always. I was going to cover some of the issues that the Chancellor recognised, in that in order to build the UK economy, it's essential to reduce economic inactivity. It's essential to address low productivity. And as Glyn said, he proposed to do this through a 4-pillar strategy based on the letter E, which is enterprise, employment, education, and everywhere. Obviously, I'm an employment taxes specialist. I head the National Employment Tax Practice here at BDO, so employment is very close to my heart. It is key to growth, And the nub of the issue is that there are currently 1 million vacancies, but almost 7 million adults not in work. So that's the economically inactive as well as the unemployed. So what the Chancellor was looking to do was to remove the barriers preventing people from working, and that this is essential not only for businesses to grow, but also to effectively meet current demand. The Chancellor focused on 4 cohorts to address that group, being number 1, the long-term sick and disabled, 2, older workers, though in common with the Chancellor, as an over 50, I like to consider myself experienced rather than old. So we'll think of them as experienced workers in this context. Number 3, welfare recipients, and number 4, parents. And I'm going to very quickly cover the key proposals which will impact employers in this regard. So next slide, please. It's widely recognised that the high cost of childcare is preventing parents from returning to work after the birth of a child. Care costs typically represent nearly 30% of the average wage for a couple with 2 children, which is a massive amount. And there has been a huge outcry calling, call it what you will, in order to reduce that, because it's nearly twice the OECD average for percentage of earnings. It's estimated that addressing this issue for the 1.7 million people, predominantly women, who cite looking after home and family as the reason for their economic inactivity, could bring back 1 million people into the workplace, and that will vitally fill a skills gap. There are 435,000 parents of children aged under 3 years old. So what the government has suggested it will do is to provide 30 hours per week for 38 weeks per year of free childcare for working parents with children aged 9 months to 3 years old. It's going to cost about £4.1 billion. Interestingly, that ties in with the typical period that somebody will be off on shared parental leave. So there will be less interruption of careers for those in parenthood, and it will be phased in to allow the infrastructure to be put in place. So from April 2024, the parents of 2-year-olds will be entitled to 15 hours free childcare. From September 2024, that increases to cover 9-month-old babies to 2-year-old children, again 15 hours of free childcare. And a year later, September 2025, that is extended to the full 30 free hours for every 38 weeks in the year. To address concerns in the childcare industry, the government funding just isn't enough to cover the costs of providing childcare. There are also proposals to substantially increase the hourly funding rate paid to providers. The other thing that they're going to do is to extend the ratio. Currently, it's 1 carer for 4 children. That's going to move into line with the rules in Scotland, where it's 1 carer for 5 children. So again, that will enable more income to be set against potentially lower costs. There's also suggestions for wraparound care. Now that's going to apply to primary school age children, giving care in a school environment between 8 AM and 6 PM, so fitting in better with the working day. There'll also be an increase in childcare payments for families claiming universal credit. That's going up to £951 for 1 child and over £1,000 for 2. And there'll be upfront payments, which have been called for quite a long time now, because they're currently paid in arrears, which doesn't help as much. So turning to measures to support the long-term sick and the over 50s, there's a focus on occupational health. So there is a forthcoming occupational health pilot study, which will cover small and medium-sized companies. And that's going to be expanded. It was announced in 2021. There's also going to be a consultation on options to incentivise greater take-up of occupational health provision through the tax system. We don't have any details of that. We'll be looking forward to seeing how that will work. And there'll be increased regulation to require employers to provide occupational health. For the over 50s, we will have returnships, and there will also be English language training for Ukrainians who have come to the UK as a result of the conflict with Russia. There's been quite a bit of controversy over the next provision. You might have seen the news where there have been calls to reverse it as it targets the most highly paid. But what will happen is that the pension annual allowance will increase to 60,000 from the next tax year, and there are proposals to put in place legislation to remove the lifetime allowance altogether. There's a call for evidence on flexible working, so that's going to oh, sorry, there's an error on this slide. So there's a call for evidence on flexible working. The expansion of the range of activities actually relates to the need to attract more talent from outside the UK, which will result in a simplification of the business visitors rules. Now that's where we're having a range of activities which are being expanded and can be carried on for 6 months, and they're also going to review the permitted paid arrangements. So look out for that in the summer. Finally, the Migration Advisory Committee made a number of recommendations, and that's going to result in the addition of 5 construction occupations which will go on the shortage occupation list following the review for the construction and hospitality sectors. So look out for that going forwards. Next slide, please. I'm not going to go through this slide in a great deal of detail because it says the same thing, but basically in the last budget it was announced that we would have a pathway for certainty with regard to national insurance, and basically the main national insurance rates will remain frozen to April 2028 unless anything changes in the meantime. So no changes with regard to the national insurance regime as it stands. Next slide, please. Now, something that we do know about already is that we need to be looking at cost-effective benefits, and we also need to have an eye on the ESG agenda with regard to what we're doing in terms of helping the environment. And we know that there's a government push to go to fully electric vehicles from 2030. So what is happening with regard to electric vehicles as company cars? You can still offer salary sacrifice arrangements for electric vehicles in a tax efficient manner. The introduction of OPRA some years ago meant that you would, for most benefits, an employee will be taxed on the higher of the salary they've given up or the value of the benefit they receive. That doesn't apply with regard to electric vehicles, where the benefit of the provision of the car will be the amount that's taxed in a salary sacrifice arrangement. Now, the benefit in kind on electric cars is very low, and it remains very low. It is increasing, but not as quickly as the charges on other forms of vehicles. Electric, I'm not going to read out the slide, you can read it for yourself, but as you can see, there will be a maximum appropriate percentage of 5% for electric cars and low emission cars, compared to up to 37% for other vehicles. The van benefit charge, car and van fuel benefit charges from April 2023 will go up in line with CPI, so watch out for changes there. Next slide, please. So finally, what changes should we be looking out for employers in the near future? Now, with very short notice, HMRC have informed us that for 2022-23, so the current tax year, you will not be able to submit paper P11Ds anymore. So have a look at your P11D software. Make sure that you can submit your P11Ds online. If you've got any problems, look over onto the BDO store and have a look at the P11D software there, because that will enable you to do that in accordance with HMRC's new rules. The next change will be significant for a large number of employers. As we all know, minimum wage and the national living wage will be going up from the beginning of April, and it will be going up by, on average, 10%. Now, for those with a large number of low-paid workers, that will have a significant impact on the cost base. Given the increased activity from HMRC, so there is a lot of targeted investigations with regard to national minimum wage, there is a great deal of work with regard to whistleblowers, and if a single employee writes to HMRC to suggest that they might be paid less than NMW and LW, then HMRC are obliged to look into it, and those investigations can be extremely thorough, extremely time consuming. So we could be talking years, not months. So it's really, really important to make sure that you can navigate the complex national minimum wage legislation, make sure that you're not falling into the traps where quite often those who are offering caring, let's say, benefits to their employees can accidentally get caught. So, for example, an employer might say, it's been cold, we would like to offer free breakfasts for our employees before work. They can come into the canteen, everyone's offered the free breakfast, so it's not taxable, and it's a good thing to do, a meal and warmth, when we're in the middle of the crisis. Now, in that case, if the employees are clocking in when they arrive, as they would have done before, and gone to have their toast, their porridge, their coffee, they're then available for work, and that counts as time for a number of them for national minimum wage purposes. So there are some really quite frightening war stories out there with regard to national minimum wage. Moving on to the employment allocation of tips bills, the second reading was on the 3rd of March. It's currently in the committee stage. We're expecting that to happen on the 27th. Basically, these provisions are that employers must distribute the total amount of tips and services charges to workers without deductions. So if you're in the hospitality sector, just make sure that your systems are in place to make sure that all of tips, 100%, go to the relevant workers. It will be a popular provision. I cannot see it changing, so you just need to make sure that your policies, procedures are in place. Finally, looking at tax simplification, there was a great deal of simplification we were hoping to see. So, for example, there are 3 different ways that you can tax the provision of a chair provided to your employee to enable them to work comfortably at home. That's not sensible. That really should change going forward. But we didn't see anything there this time round. What we did see was agent accessing to the payrolling of benefits in kind. There will be new IT systems to enable us to do that. It will help to reduce the burden on employers and to enable agents to support their clients more effectively. We would have liked to see more wide-ranging provisions, but this provision is, of course, welcome. Finally, I don't have a bullet point on this slide, but because it's not something that is happening just yet, but we have a call for evidence which will be launched with regard to the simplification of the 2 tax-advantaged all-employee share schemes. So that's the SIP, Savings Investment Plan, and the SAYE, Save As You Earn scheme. So they're both very complicated at the moment, and potentially there could be some work done to simplify those arrangements and increase uptake. And EMI remains the most tax-advantaged way to provide share-based incentives to your employees if you qualify. There are some complexities which are being removed. So from April 2023, there will no longer be a need to set out the details of the restrictions applying to shares under option within the option agreement. And there will be no need for the employees to sign a working time declaration. So that significantly decreases the administration, and it will make it easier to provide EMI options to employees in the way that the legislation originally intended. And finally, from April 2024, a very welcome change will be the removal of the need to notify the grant of qualifying EMI options within 92 days. That will move to the 6th of July following the end of the tax year in which the options are granted. So that's a quick summary of employment and employment taxes changes. And I'm now going to hand you back to Glyn, who's going to talk to you about VAT.
Thanks ever so much, Caroline. Brilliant. Fantastic. Let's have the first indirect tax slide. Great. Indirect taxes, again, not a massive amount of change, not an awful lot of stuff going on here, nothing big, nothing particularly scary, but a whole raft of very, very small tweaks, which I'm going to try and canter through in reasonable time, because I'm sure they're going to impact on somebody on the call somewhere, but there are so many and so wide-ranging that it's going to be there. The rumour I've heard quite strongly from the Treasury is that ever since the pasty tax budget, the indirect tax people are basically ignored when it comes to budget changes. So I'm not entirely sure how true that is, but it sounds very, very likely. No big changes to the VAT rates or registration threshold. Plastic packaging tax has been increased in line with CPI, which takes it to £210.82 per tonne. There's also a lot of technical changes to the penalty regime, basically to ensure that people who pay their plastic packaging tax late are going to be the same regardless of whereabouts they sit within that particular chain. A technical change, but probably a welcome one. Alcohol duties, one of my favourites. Duty rates in all alcoholic products are going to be increased in line with RPI, with the exception of draft beers and ciders, etc., in pubs, which the release has been increased to cover that. Alcohol duty reform is still going ahead, so the government will legislate now to make changes to the duty structure, basically introducing bands which make a lot more sense because they're more on volume than what their underlying product is. And there's going to be a couple of new reliefs and some transitional arrangements for those products taking place from August this year. If that's of interest to you, please do reach out to our customs team. We'll be able to help you a lot more on that. The deposit return scheme, there is going to be some simplified VAT treatment allowed for that, so that actually the deposit amount falls outside of the taxable amount, so that actually you don't get charged VAT on it, and VAT only gets paid when you don't recycle those bottles. Moving on to the next slide, please. Couple of very, very specific changes on pharmacists. The VAT exemption for medical services being provided by pharmacists is now going to be extended to people who are directly supervised by a pharmacist, pretty much in line with the rest of the medical exemption, where obviously people who are under direct supervision of a doctor are also included there. That'll take effect from May 23. Patient group directions, these are the special rules that allow some people to certain categories of people to dispense drugs, like podiatrists and dental technicians and what have you. The zero rating is going to be extended to those, so that's very welcome. A really welcome thing is the customs advanced rulings. It's a very throwaway line, but I know how important this is to importers. The revenue will now be given the power to provide advanced valuation rulings as well as binding tariff rulings. These valuation rulings will be binding on the revenue and will be binding on taxpayers as well. They're not compulsory, but they're going to be really welcome. And one of the most complex areas for people importing goods is often the valuation, because you've got to add in various different bits to the customs value, but as well as, if there's no obvious customs value, there's a massive, great big load of legislation that talks to you about how you have to do that. Actually getting that pre-agreed with the revenue will be very, very welcome indeed. I mentioned the VAT gap in the autumn budget. It's been revised downwards, so congratulations to the revenue. We're only missing out on £7 billion worth of VAT, rather than the £10 billion that we thought we were. That VAT gap has been revised downwards, both from their expectations and the amount of VAT that's actually been paid. So that I guess is good news. And actually, if you look at it, compare it to Germany, France, and Italy, it's modest anyway. Let's move on to the next slide. Cool. Those of you building your own house at home, the DIY house builder scheme is about to enter the 21st century. The revenue will digitise that scheme, which is very welcome, because otherwise you end up with large bundles of documents going backwards and forwards. And the time limits are going to be extended from 3 months to 6 months, which is, once again, very welcome indeed. What isn't covered in there is the fact that you can only make one DIY scheme claim. So there may be some further changes on that, given the case law in that area, but broadly positive news. There's a load of consultations and discussions of different types being announced. VAT on fund management reform, all the responses are now in. The revenue are considering those responses and are going to let us know what they think in the next few months, apparently. VAT treatment of financial services, the reform of the VAT exemption overall. The government is working with stakeholder groups rather than having an open discussion on that. So if you're interested in that, please reach out to one of your stakeholder groups. Either, BDO are part of that, but obviously there are various trade bodies also involved in that. Energy saving materials, there's going to be a call for evidence out. Well, there is a call for evidence out that will be due to be done by the end of May 2023. That will relate to what energy saving materials get covered, including new technologies such as battery storage, etc. But also of interest to the not-for-profit people, whether it should also be extended to energy saving materials in relevant charitable buildings, RCPs, buildings for a relevant charitable purpose. So that's going to be interesting. Customs guarantees, special procedures, once again, engagement with stakeholder groups rather than an open thing. So if that's of interest, reach out to the customs guys. And voluntary standards for customs intermediaries, that consultation is going to be summer this year. So if we move on to the next slide. A very, very niche area on red diesel. The things that the red diesel can be used for has been expanded to cover 3 new areas. I won't go through them in detail because I think it's probably of limited interest on this call, although I know at least one person on this call will be interested. So that has changed. Be a little bit careful with those. I think when you look at the actual rules, they are slightly tighter than the initial announcement. So if you're relying on them, do have a proper look and kick the tires on that. So if we move on to the final indirect tax slide. VAT is 50 years old. A big happy birthday to value added tax. It was originally announced, obviously, the 1st of April 1973. Some of my corporate tax colleagues have been unkind enough to suggest that April Fool's Day was a great day for it to be introduced. Launched as a simple tax, I think we can agree that it's turned out to be anything but. And my favourite quote ever in a court case was the Lord Justice saying, beyond the everyday world, both council have explained to us, lies the world of VAT, a kind of fiscal theme park where actual and contractual realities are subverted and inverted. It's been fun for the last 50 years. Hopefully we can have another 50 years. Obviously, post-Brexit, great opportunity now for reform. The Office for Tax Simplification has for a long time suggested the removal of the registration VAT cliff edge. So as soon as you reach £85,000, your VAT registrable, that sometimes has a suppressing effect on growth, or particularly in the retail sector. Maybe we can review and simplify some of the VAT rates. That would certainly be welcome, and I guess social support reliefs, are sometimes look a little odd. So maybe we'll see a little bit of that, and maybe we'll get rid of the system altogether. And certainly Michael Gove suggested as much when he stood for Tory party leadership. Fortunately, that didn't happen. So there we go. I think that's all we got on indirect taxes. So I'm going to step back now and let Ben talk to us about personal taxes. Thanks, Ben.
Thank you, Glyn. Good morning, everybody. Hopefully, I had some Wi-Fi issues today, but hopefully it's running fine. Feels like a little mini lockdown in the Handley household today because of a train strike action. Both my wife and I are at home. Teacher strike action. My 12-year-old is in the house somewhere. I'm sure he's doing his homework, and I'm sure he's not on computer games, but we'll find out later. But if we move on to the next slide, please. So this slide, for those of you who joined us at our autumn statement webinar, this slide will be very familiar because this was all announced then in terms of the rate, the changes and the freezes that were coming into force from 6th of April this year. So the big ones were, well, the reduction where we pay the higher rate of tax went down from 150,000 to 125,140, but all other rates were essentially frozen until 27-28. I think there was a sort of record collection tax take, perhaps doing a bit better than expected. So maybe some more hopeful, optimistic people may have seen maybe looking out for a change or an unfreezing of those, but sadly not. As we stand here today, those freezes are set to take place until 5th of April 28. Those rates you can work through yourself. You'll be familiar with those. The bugbear of mine is always the 100,000 limit before you start losing on your rate band. So when you go from 100 to 125,000, that 25,000 is essentially taxed at 60%. But I guess we just have to live with that for the time being. If we move on to the next slide, please. So what we called it was tax by stealth, and so we won't miss what we won't have. And so if we look forward, you know, we would have been better off if rates had risen in line with inflation. So they won't. But the red book will say what the HMRC are expecting the impact of these changes to be, that there's going to be more high rate taxpayers. So there's going to be another over 1 million by 27, 28. I think there's about 6 million or so at the moment. So that will go to well above 7 million, and more additional rate taxpayers, over 300,000 additional rate taxpayers as well through these measures of freezing the rates. And the government going to take an extra 3 billion in tax through freezing the rates, they estimate, by 27, 28. Next slide, please. So this is for business owners. This is our effective tax rate slide. So this looks at the total tax that people pay. When you look at the tax the company pays, you then look at the tax the individual would pay on extracting those profits. And as we highlighted before, historically, it has been better to take dividend rather than salary or bonus. If we move forward from 6th of April this year, you'll see, particularly for the higher rate taxpayers, for the first time since I can remember, that slightly reverses, and the salary bonus method of extracting profits from the business is slightly more efficient than the dividend model. Let's move on, please. I'm conscious of time as well. We won't rush through it too much, but conscious of time. So this was the I suppose unexpected announcement, I would say, from yesterday, certainly in terms of the abolition of the lifetime allowance. So I think I'm always glad. I think I'm a tax advisor rather than a tax commentator or policy maker, because I'm pretty sure at the autumn statement in November, given the big tax gap, we thought there may be a sort of further restriction on pension contributions, but as it transpired, we roll forward to yesterday, and the announcement that the lifetime limit is abolished, and also further increases to the amount we can contribute and get tax relief to the pensions. So lifetime limits is 1,073,000 as we stand here today. From 6th of April 23, that will be abolished. Now, what that means is people can put more than 1 million in their pension pot, but you were penalised for doing so with effectively a 55% tax when you drew that out. Either 55% tax on a lump sum payment on the excess over the lifetime, on the funds over the lifetime allowance, or a top up of 25% tax on the excess to effectively get you to 55% tax when you draw that pension as income. So that, as we stand here today, it is going. I think it was widely reported, I think, that the expectation was the lifetime limits would be increased to about 1.8 million against the backdrop of supporting to doctors, where it's becoming, you know, why is the point of taking extra work? Because I can't choose how much goes into my pension. I'm being penalised for doing it. But they've decided to scrap it altogether. I know Labour have come out and said they would transform that immediately. There are lots of questions out there that we still just don't naturally know as we go 24 hours later and work through the detail, and can't possibly validly comment on, I'd say, at this day and age, because if we say that, you know, if they do reinstate it, what does that mean? That people have broken it in the interim? You know, one would always hope, you know, sense prevails, and those that have, there will be sort of grandfathering provisions, and those are topped up. But I think we'll sort of wait to see the more detail as we work through it. And then the pensions lump sum, the tax-free amount, as we call it, when you first draw down on a pension, that will be capped at the 25% of the 1,073,000, unless people have already got higher protection in place. So that lifetime allowance has changed over the years. Looking back a few years, it was 1.8, 1.5. So people might have already had higher protection in place for those pension pots. The annual allowance for pension contributions, so we could put in 40,000, it's now 60,000 a year, but that amount was also tapered for those that are earning above a certain amount. So previously, for every amount, well, currently as we stand here today, every amount you earn over 240,000, for every £2, that taper amount reduces by £1. It goes down to 4,000. From 6 April 23, the fully tapered amount is going to be 10,000. So regardless of how much you earn, you can at least put 10,000 in. Also, the increase to similar levels for the money purchase annual allowance. So that's for those that people have already taken a pension, how much they can sort of put into a new pension, top up pension. So that was 4,000 previously. It's now going up to 10,000 again. So this is very much on message of perhaps getting experienced people back to work, and giving them another incentive that they can still sort of continue to top up pensions with some form of reasonable amount as we go forward. Next slide, please. Capital gains tax, inheritance tax, again, just mention it because no changes. Normally when it comes up to budgets, there's always a little bit of nervousness or thoughts around will there be changes to capital gains, either rates or reliefs, inheritance tax rates or reliefs. No changes there. And as we sort of said before, you know, for the capital gains tax, it's still, in my view, 20% as the standard rate is still relatively competitive. 10% for lower tax earners, and obviously residential property and carried interest tax at the higher rates of 28% for those higher rate payers. The annual allowance for capital gains tax, so currently 12,000, is going to be reduced to 6,000 next year and then to 3,000. Again, it's probably not going to be something that influences people's decisions of whether to sell businesses or not, but I do appreciate that the nil rate band was useful to those who maybe take the opportunity to kind of realise gains on stocks to fund lifestyle needs and so on. Inheritance tax thresholds maintained as well, again, until 27, 28. So this is the nil rate band for 325,000. And the additional bit you get to cover your residential home, the extra 175,000. So basically, a couple could have up to £1 million to include to shelter IHT, to include their main home. Main rate is still 40%. It's been a long time since the cross-parliamentary committee came out, and we're sort of yet to see any further meaningful noises or movements on inheritance tax rates and bands. Next slide, please. Yep, so I think the message is still plan ahead to manage the tax bills. You know, ISAs, so everybody still have up to £20,000 in an ISA, which remain efficient. Junior ISAs as well for the young children. Pension contributions, as we just talked, you know, especially, you know, that bit between the 100 and 125,000 where we get that 60% tax relief, insofar as, you know, affordability needs enable, that's probably the point to start increasing the pension contributions to get tax relief at that level. Electric company cars, as Caroline said, I'm a big fan myself, and it's where if you can sacrifice your salary in exchange for electric company car, it's sort of, I personally think it's a bit mind-blowing compared to a normal car, but maybe it sort of comes out in the wash and people have their reservations about range anxiety and so on. And there still remain lots of other ways to manage tax costs, you know, think ahead, plan ahead, to manage capital gains and inheritance tax liabilities, and aim to take a sort of long-term view on these. And check out our personal tax planning guide, a brilliant document with lots of ideas in ways in which people can help manage their tax liabilities going forward, which is all sensible, prudent stuff to be thinking about. Next slide, please. And a quick one on HMRC powers and enforcement. Next slide over, please. So tax debt. So this is the amount that HMRC is agreed and is collectible, but they've not managed to collect. So at 31 December, that stood at 48 billion, which I think was up from about 42 billion the Q1 earlier in the year. I think down from its all-time high of about 70 billion during the recession, but nonetheless a big number there for HMRC to collect. So in the budget, they did announce, I think, a £47 million package to introduce further measures over the next 5 years to help them tackle that debt. And that's a combination of things, from helping them understand better those who can pay but choose not to, as opposed to those that are genuinely struggling, having the self-serve time to pay available to all, where people can make arrangements to pay over time rather than the fixed normal dates, and also investing maybe a bit more in debt collectors as well. So, and a late payment interest I just mentioned there as well for those with outstanding debt. This time last year, interest rates were lower, and that was at 3%. It's now at 6.5% on late payment interest. So things it's worth, if there are those with outstanding tax debts, I think the best thing is to communicate with HMRC, at least make them aware before they have debt collectors after you, and see if there's things that can be done around time to pay arrangements. And then finally, nudge mania. Nudge mania continues. So I think at last count, I've seen about 18 different types of nudge letters. There will maybe more. So these are letters where HMRC will send to taxpayers, basically just saying, are you sure? Are you sure you got it right? And they range from things that we've had from offshore disclosures. We've had various types of ones on property in terms of reporting property income. There's recently on R&D claims as well, to encourage people to check their claims and make sure they've got those right. Business asset disposal relief, things making sure that, are you sure you've claimed the right amount and you haven't previously claimed it? So various things are right there to just notify taxpayers, just to sort of check their affairs. So we do have a list of those, so do reach out, and it can be useful just to share the types of things we're seeing there. And the important point to say is that a nudge letter does count as a prompt. So when you come to settle outstanding tax liabilities, there's tax to pay, there's interest on that overdue tax, and there are penalties as well, which can range wildly depending on people's behaviours. An unprompted collaborative disclosure is the best place to be. A prompted uncollaborative one is the worst. But just to say that nudge letter, if you are brought into action through nudge letters, that acts as a prompt. So you won't, you'll be at the higher end of the penalties rather than lower, if that makes sense. So I think that's all I wanted to talk to for now, taking us to a bit over 11 o'clock. But perhaps we'll go back to, I think Glyn might be hosting us for questions. And
brilliant, absolutely fantastic, Ben, and fascinating with those nudge letters. We're even getting nudge letters on indirect taxes, which is a bit of a surprise. We're running a little bit short of time, so I'd like to bash straight into some questions if we can. Predictably, an awful lot of those questions are for you, Liam. Bad luck. So let's hit some straight away, shall we? Let me get to the top of my questions. I'm interested to know whether the new rules on expensing capital expenditure will also apply where contracts have already been signed.
Yeah, that's a really good one, and I've seen that's cropped up a couple of times in the questions. And I guess that's prompted by the fact that when we transitioned into the super deduction, if you'd entered into a contract before that was announced, you weren't entitled to that. The short answer is that hasn't been announced yet. It's to be confirmed as to whether contracts that were entered into before 15th of March would qualify for this. My personal take on it, it would be rather odd if they didn't, because we're transitioning from a relief where in the current period you get 130% deduction into sort of next year you're going to get 100% deduction. And it would be a little bit odd if you kind of had some contracts for a period of time that actually sort of flowed through into next year's claim, but where the contracts were signed before the 15th of March, that you were somehow penalised. But it is a possibility. To be confirmed is the answer.
Great. Right. Clear answer. Thank you, Liam. Once again with you, about the 100% capital allowances, is it clear if the existing 18% and disclosure regime will continue to apply at the same time, or will all property and plant additions have to be treated as eligible for the 100%?
Yeah, it's a great question again, and I think there is going to be the option to disclaim and not claim the allowances, and I think this probably interacts with the initial exemption allowance as well. If you fall within the initial exemption allowance, or if you fall in some other sort of 100% sort of allowance, What you might then avoid is the two new regimes, the expense regime and the 50% first year allowances, both have a clawback. So if you dispose of the assets, say if you're in the 100% expense allowance, if you dispose of that asset, any proceeds that you receive will crystallize a balancing allowance, so that will come through as taxable income. Whereas ordinarily, if you were in the sort of the main pool, that would just sort of be proceeds going into the pool that would reduce further allowances. So there is definitely quite a bit of detail that sits behind this. But for the chap who asked the question, are you still able to disclaim? I believe you will be, yeah.
Cool. And on the first year allowances, am I getting some feedback here? So on the first year allowances, new company incurring expenditure in the qualifying period, but trading activity starting after March 26, can they bank those allowances and claim them when the trading activities begin, or are they trapped?
I'd need to sort of look into that one, but I think probably what there is, again, to point out that it's helpful that there is sort of there is, of course, sort of still the annual investment allowance that would still be available, and depending upon the level of expenditure, you know, that's still might fall within that.
Right. And one final one for you, I think. If the R&D expenditure is in a wholly owned subsidiary, an SME of a large corporate group, does the SME rate still apply? I assume not, but
yeah, no, I think you're right. There are tests that in terms of applying what is an SME and what is an RDIC, there are sort of various provisions which can be quite complicated that force you to take other entities into account.
Cool as. I'm going to throw a question at myself now. The plastic packaging tax increase goes ahead from April this year. So for the person who answered that, a bad luck for being in the plastic packaging tax regime, but yeah, it comes in from April, and apologies for not putting that on the slide. I think I've got a question for Ben, actually, which would be a good one if I can find it. Ben, on pensions, does that mean that the 312,000 top before it hits a new 10k minimum is changing, or is it staying as it is?
I think it will be 360,000. So I think how that cap works is that, so for every £2 you earn above 260,000, the amount you can contribute is reduced by £1. So if you work that through, 260 becomes 360. That 100,000 reduces the amount you can put in by 50,000. So that makes your 60,000 10,000. So I'm pretty sure it's 360,000 and above will be where you're then capped to the 10,000.
Very clear. Thank you, Ben. I think we've run out of time. We've literally got less than a minute left. So with apologies to Caroline not getting to any of your questions, we will try and answer these questions for you and come back to you with full answers. I know there's some really good questions in there, and apologies if we didn't get to yours. Thank you very much indeed for all the presenters, with the exception of me. I thought they were very good. And you know, thank you very much for staying with us. We've managed to keep nearly everybody in the session, so thank you very much indeed. And we look forward to speaking to you all again. Thank you very much.